I think that my best guess is that we will get a triple digit spike in oil, and that'll be somewhere in like Q2. And if you go back, oil almost always spikes prior to a recession and at the very early stages of a recession. So it's right along with history. It kind of helps push the economy off a ledge. And so that's how I think it's going to go. But that's not going to be enough to reverse the CPI going lower, because when you think about CPI, this is why I say nobody can project inflation out more than 12 months, because it's hard to do it even in 12 months. But you can basically look on a 12-month basis back 1 year and say, okay, what are our comparisons? And for oil, when we go into the spring, we had basically $150 a barrel oil. Then we had record high crack spreads. We had like $60 a barrel crack spreads on top of that. So the consumer prices, the consumer was taking in like about $220 a barrel products back, at the height of the oil spike in spring of this year. So when you roll into next spring, that's your comparison. So even if oil was $100 and crack spreads were $25, which is decent, even if you had that environment, that's as crazy as it sounds, that reads through in the CPI as deflation, not disinflation, deflation, where you're going to be printing in that energy component of CPI, you're going to be printing negatives. So don't see oil pushing the CPI higher, but what it can do is it can mute the disinflation message that the Fed's seeing, and then it could push the Fed to wobble a little bit and maybe extend out the hike cycle, things like that. So the longer the Fed waits to pause, though, the worse the subsequent drawdown is going to be, in my view.